Hi guys, Harry Yotis here, professional trader for 20 years. Started my career in 2005 and still alive in 2026. So today, chart of the S&P 500. This is definitely the squeeze from hell. And yes, it's continuing despite against all odds, it's still going higher. Okay? So today we are Thursday, May the 7th, and we had some kind of like an inside day. We opened up higher and we finished, let's say, the top third of yesterday's big move. Okay, so the squeeze from hell, yeah, that's what it is. I mean, who's ever caught short here is feeling a maximum pain. However, we still don't see a lot of like overbought conditions here. I still see a lot of fear in the markets going higher. So this is good for the bullish thesis. Okay, so we'll get to the squeeze from hell and what that means, because there's a lot of news with the war and with the Strait of Hormuz and, the usual suspects, okay? And we'll talk more in depth about that and my views on that going forward, as well as some trades that I'm looking to do. Later on in this video, we'll talk about that. But first, we always talk about the technical picture. And guys, it's still bullish. The technical picture is still bullish. Nothing is broken and there's been no pullback. Although I still believe that we are going to get a pullback of some kind. But I do know, like let's say with like an 85% certainty that any pullback is going to be short-lived. Okay, that's what I think. It's just this market is very, very strong, and it would be foolish to ignore that. Okay, so with the technical picture, which is bullish, we always go with the sentiment. Still greed 68. Nothing really changed from yesterday. We haven't touched extreme greed yet. Yet some of the sub indices are at extreme greed. And this is what bothers me. It's this put call ratio at extreme greed, which is a lot of call buyers are in the game and they're buying at highs, and they have been buying at highs for 2 days now. Okay, so we have this greed, we have that at highs, although we are still not technically stretched too high if you look at some of the other oscillators. But that the calls have to get punished somehow, yet they are not. They're still holding in, and we said we have the potential yesterday to drift to the end of the week higher before some kind of meaningful correction comes in. Okay, so this is what bothers me. It's this extreme greed in the put-call ratio, which a lot of calls being bought in the sentiment index. However, we are still not at extreme greed. We can still get there. Okay, let's say we do get that correction. Okay, and it falls somewhere around here, 715, 710. Let's say. We're going to go down to neutral, which will feed another move higher into even higher territory, okay? So it just feeds the bullish thesis going forward, okay? And on Thursday, we always get my favorite sentiment reading is the AAII Investor Sentiment Survey, or as Ilhan Omar would say, the AA11 Investor Sentiment Survey. So we are basically, this week we are at typical levels, at average levels. Look, last week we just had the bulls at 38% and the average is 37.5, and they're still at 38%. So average bullishness and average, let's say average bearishness. No extremes. Okay, we had this 1 week, 2 weeks ago of extreme bearishness, and I was telling you guys the bears are extreme bullishness, and I was telling you guys the bears are still around. Okay, it's just 1 week. It hasn't solidified yet, and yet again, it hasn't solidified. That's why I'm still bullish. Okay, we need to see this kind of 40% for like 4, 5, 6 weeks in a row. No, we're still getting fear type readings at the top. It has to do with the war, I guess, but so far the bears are still sticking in there. So nothing really solid yet. This is why I think any pullback will get bought, because any pullback, and you're going to get something like the bears, boom, are going to sneak their head back in. Okay, because the bulls are not there yet. I'm saying the herd of bulls is not there. A few bulls are there, but there too many bears hang around. We have to kill the bears, and the bears are always lingering, and there's fear. And this is why we have a wall of worry still with this market, which I love. Okay, so we did have a macro print every Thursday. We look at the initial jobless claims, and guess what? We keep getting good news. The economy is doing well, and and everybody's ignoring it. Okay, we have revisions in earnings higher, like we mentioned a while back. We have GDP revised higher. Everything is doing well under the hood. Okay, we basically had 200,000 of initial claims. Nothing. That's anemic. It's nobody's filing for unemployment. The underlying strength of the economy is apparent. Okay, if you just look at it. Okay, we also, like, if you look at continuing claims, we have to look at continuing claims for a while. Look at that, off a cliff, down to like 1.77 million, I guess. It's very, very muted. People are not filing or taking unemployment. That's it. Okay, so another positive macro print. Okay, so let's get to the squeeze from hell. What this means, and what we can expect going forward. Of course, it's all about the war. The big news on CNBC is Iran still reviewing the new U.S. peace proposal, and Trump predicts war will be over quickly. Okay, same thing. The odds are that this war is probably going to end. However, if we look at oil, it's saying a different story. We're stuck at the highs, yes. Yesterday we had a move down on the peace proposal, but then it was recovered quickly with this wick, and I mentioned that I don't like the wick. We also said it's hovering around the 100 level these past couple of months. And today we had another good news event in the morning and then bought back up. We have two wicky moves here, okay? So if I just looked at this chart, I would say this is still bullish because people try to sell it, sellers try to come in, and it was bought up by the bull. So this looks bullish for oil, technically speaking. Okay, and look, we have a higher low, higher high. Nothing has been violated, although here we have a lower high. So we're just trending sideways, but this is basically keeping us within this range, and it looks pretty bullish. However, if you look at the SPY is already telling you it's over. Oil is done. Because oil, it's saying that oil, meaning the war, is over, okay? And it was over this day right here, okay? When the market and oil both went up. It's like the war is over, so the oil doesn't know it yet, and the market does. And I don't bet against the market, because the market knows more than the oil market, I say. Why? Well, because oil, U.S. oil and all that is going off of what's happening now. Okay? This is the supply and demand picture now, okay? It doesn't look 6 months ahead or a year ahead. Okay, where you can see it's probably going lower. The futures contracts are lower 6 months ahead than they are now. This is spot oil. It doesn't predict the future, whereas the market is a discounting mechanism, if you will. It anticipates the future by 6 months at least. So I think this is why oil is still way too high compared to what it should be, quote unquote, should be. And by should, I mean where the market is telling you it should be. This market is telling you that oil is going to be down in 6 months. Okay, the war is going to be over, basically. So this is why there is an opportunity, and I am still short oil. Okay, I took some shorts, you guys know, and I'm still longer term, and I think it plays out longer term to the downside. Even though if I just look at this, technically speaking, this is very bullish. 2 weeks on a rising chart, very volatile, which is good. I think it's going to blow up higher. It's very possible. But I just look at the market. The market is saying the opposite. The market is saying, fundamentally speaking, this war is basically over, and it should drift lower. The oil market will find a way to supply their users. Okay, so that's the squeeze from hell continues because of that. Okay, because of the strength, because of the market saying that this is pretty much over right now. The war, that is. Okay, so what did I do today? Basically, nothing. Okay, let's go back and look at our ServiceNow position. Okay, we mentioned that yesterday we took this position. We sold an 85 put, which is around here, and we bought an 85 put, and we collected $1.70 in credit. Okay, so this is a classic put spread. I think it's overdone. Why? Because we have positive divergence. The price is going down. Meanwhile, all of the oscillators, I would say, all of the stochastics, if you will, are going up. Okay, you have the MACD, everything is going up as the price is going down. It's telling you that this big sell-off here might be coming to an end. You know, from 220 down to 93, maybe the market's saying that's enough. Okay, so for me, that's enough of a reason to go take this bullish put pattern. Okay, I'm selling a put spread. So I also mentioned that I'm looking at Shopify. I'm going to do a trade here on Shopify, looking for it to stabilize. It looks like it's touching the bottom level here. Boom, broke it a bit, but then it's coming back. It's touching this level of support. So what I'm looking to do, you can do a couple of things. Okay, so first let's go to the options thing on Shopify. What I would prefer to do. Okay, Shopify. Okay, let's look June, which is 42 days. Yeah, it's pretty reasonable. It's the monthly. You should do the monthly, because if you do the weekly, you're going to get huge spreads between the bid ask, and it's not worth it. Okay. So what I'm looking to do, there's two options. The first thing that you can do is look at the deltas here, the puts, the deltas. I'm trying to go along. You're trying to find one that is out of the money, but not too far out of the money. If you pick a 16 delta here, which is the 90 put, this is a 16, 17 delta. That's like a 1 standard deviation away. Okay, it's telling you 1 standard deviation away. It's the expected move. Okay, after a big down move, this is a good place to go to short if you want. Okay, but I would like to go a little bit more aggressive, collect a little bit more premium. I'm looking to sell the 95 put. Okay, and I want to get a good price. I want to get like 250 around. Okay, if the market goes down again, I might be able to get the 250. Okay, I will do this naked. This is one of my things that I like to do, is go naked. However, if you don't have a big enough account and you want to protect your downside, this is what you should do. You should buy the lower put. So you're selling the 95, buying the 90, and it's trading for the bid-ask spread is $1.33 to 70 cents credit. Okay, I wouldn't do this trade for less than $1. In fact, I try to get it for $1. Lowest case scenario. Okay, $1 to $1.50 would be nicer. Okay, if it ever comes down, aim for $1.50. Okay, which is one strategy that you could use. This is a defined risk. You know exactly you're going to lose maximum $5, but you collect, let's say, $1.50 if it ever goes down. So the max you can lose is $3.50. Okay, size accordingly. Whereas if you didn't do the 90 put, okay, now your risk is undefined. Okay, and you have to manage it. Okay, always go small. Always know what. Don't bet the farm on this. Is you have to do these trades like singles. Okay, so what that looks like on the chart is here you want to sell. What was it here? Oops, brush. Sell the 95 put, which is all the way down here, and you want to buy the 90 if you don't want to have any risk. Okay, so after falling from 135 to 105, which is what, 20, 25, 30% drop, you're selling a put another 10, 15% lower. Okay, so that's a good risk reward after a drop. I would do that too. This is the go-to riskless type of strategy. However, the second strategy that I would look to do is strangle, which I like to do. I collect more credits. You can have this. I would sell we could do the 20. You can sell the 95 and sell the equivalent, let's say the delta. You can sell the 25 or 30 if it's too bullish. Okay, so let's say the 30 here to be more conservative. So you're selling these two and you're collecting like 475 or 5. You can collect $5. Okay, and you can do like, if you have the capital to do this, you can go with, I don't know, maybe let's say 1 to 5 contracts. Okay, very, very small would be like 1, and you can manage it easily. This is easily manageable. Okay, whereas a spread, you would just leave it there, do or die. Okay, you can sort of manage it, but if you have a $5 spread, you're basically taking it. Okay, you can't really move it. But here, like here, if you take a strangle, you can adjust it. Okay, so the price right now is like a 110 here. So this kind of strangle, it would be like or if you want to go a classic 1 standard deviation move, would be a 16 delta on both sides. 16 delta, which is 68% of the time it'll stay within this price range after being elevated, because we're talking about 56% volatility. So this is a big range for Shopify for 42 days. So probably there's like a 1 standard deviation, a 68% chance it stays within your strikes, and you're good. Okay, but if you think if you're bullish, more bullish than not, you can put this up higher and collect more of a credit, which is, I am a little bit more bullish on the SaaS stocks right now. I think they're going to go higher, and you could be more conservative here and go down. I mean, put it higher, which would, see, remember the 95, 130. Let's go to the chart and what I mean by that. Okay. The 95 would here, this put, and you would sell the 130 to 135, which is the previous highs. You would sell a call here. So right at the resistance. Perfect. Okay, this is why you pick that, and that's the standard deviation. That's 1 standard deviation away. 95 or 90 to 130, 135. It's up to you depending on the credit you want to take and the risk you want to take. Okay, so that's what I look at. Do the strangle or just the put spread here for Shopify, which I'm probably going to do tomorrow. Okay, and by the way, that's it, guys. That's all we're going to do today. So let's go back to the SPY and conclude by saying that I still expect a down move sometime. Okay, maybe we squeeze into Friday, tomorrow, before going down. Who knows? Okay, and tomorrow, don't forget, it's the jobs report. Okay, first Friday of the month, we're going to get the jobs report. That could be a catalyst for us going down, although I don't see any damage on the job report. We've seen the initial claims down. We've seen everything. So I don't expect any surprise in the job report. All right. So that's it, guys. You have my ideas. You have what I think going forward. And let's see what happens Friday. Later.